It's just like a deja vu because last year my session was also after Germain's session. But there are two differences. My part, I'm more straightforward because Germain put their product in the last few slides. I directly put it on the cover page. And also what's, yeah, and also what's different from last year is that last year we still have a lot of uncertainties about when the Fed hike is coming to an end. But this year, at least, we are quite sure that the Fed is not going to hike and maybe even a bit dovish from the current stage. So that's why we'd like to give an update on our CSOP iEdge Leaders Index ETF. So if we look back to the last year market situation, we have to say for last year, there are still some more headwinds than tailwinds, such as the inflation costs, monetary tightening, and also the tightening spread, which are not quite friendly to S-REITs. But the good part is that even for last year, the rental reversion and occupancy are still quite resilient, and occupancy costs are still relatively manageable. To further clarify this, here the green arrows that means the positive factor, and the red one is the negative factors. And this is particularly true to S-REITs because for S-REITs, most of their exposures are still within Singapore. So the Singapore macro are still the most important factor related to the S-REITs. And if you look at the Singapore's macro growth on the left-hand side, despite some bumpy rebound, but if you look at the manufacturing PMI, they still show some improvement. And more importantly, within Singapore, the core inflation is actually cooling down, which is really a good sign for the S-REIT daily operating cost. And Sing dollar, this is maybe a bit against the intuition is that these Sing dollar strength is typically could be a headwind to S-REITs, particularly for those S-REITs with a large international exposure, because when the Sing dollar is rising, their overseas revenue can be lower. But these headwinds can turn into a tailwind once the Sing dollar start to depreciate because of inflation start to fade away, and because the US, when the US start to cut rates. So if that happens, it can create another round of rebound for the S-REITs with the international exposures. And even from a fundamental perspective, if you look at the global market or the global macro, the US, Japan, their fundamentals still looks quite resilient, and Eurozone is also bottoming out. And even China, at least the revenge spending post-reopening are still benefiting the like the malls and also the hotel REITs. And more specific to the sector outlook, if we start from these industrial REITs, we have to say most of their supply and demand are still relatively balanced except for the business parks. This means, of course, there are some increasing supply, but at least there's still some demand to match it. And as a result, as you can see on the right-hand side, most of the major industrial REITs, their rental reversions are still in the double-digit area and with a positive guidance. And on a forward-looking basis, this kind of positive rental reversions are expected to continue, even the spot rent moderate. And data center in particular still have a very, very huge demand with a nearly 100% utilization with a limited supply. This is mainly thanks to the digitalization boom and also the AI boom, which require a great demand for this calculation power. And specific to Singapore, and the build restriction also relaxed a bit, which is another good sign, because this means there will be an upcoming increasing supply to match the rising demand. And in our portfolio, now we have more than 10% in the pure data center in our portfolio. And moving to the office REITs, if you look at the right-hand side, you can see in the next couple of years, the supply will be concentrated only in a few buildings in the CBD Grade A office area. So from this perspective, we don't think there will be any immediate risk for the office supply. And we also acknowledge that there are some tech firms or Chinese firms, their leasing demand start to wane. But in the meantime, the wealth or legal or finance or insurance firms to benefit from this credit demand bottoming and also the regrowth. And more importantly, the flight to quality or flight to green and the relocation cost consideration, they still benefit the S-REITs retention ratios, particularly for these grade A offices. So that's also explain why the largest office REITs, they still has a very good rental reversions change, as well as good guidance. But comparatively, if you look beyond Singapore, the US, UK, and Australia, those offices are still impacted by the work from home arrangement. And in terms of these retail rates, it's very interesting to know that despite the shopper traffic, the people flow being still below the pre-COVID levels, but the sales has far exceeded. These mainly reflect this impact of the inflation. And so the further recovery in the traffic or the volume will therefore boost the sales further. And within Singapore, the downtown malls are still seeing some stronger performance than the suburban malls back to last year. This is mainly because of the more inbound tourists. And this kind of tourism recovery boosted by this strong pipeline of the MICE events and also the concerts will continue to support the tourism as well as the downtown retail sector. And as a result, as you can see here, the CBD-related retail leasing is still very strong because of the retailers' confidence in the tourism recovery and also the back-to-office crowds, together with the new Chinese retailers, such as the Chinese brand, the restaurants everywhere in Singapore. And another reason for the strong rental reversions is because of the typical 3-year length of the leases. They are renewing the COVID-impacted rents, which used to be low with subsidies, but now the rents are also inflating. And again, similar to the office REITs, the limited supply of the retail REITs can also boost the whole retail REIT sector. And the tourism rebound is not only impact the retail REITs, but also more directly drive the hotel REIT sector. Because after the reopening, you can see here the Singapore visitor arrivals hit 13.6 million last year, and also expected to reach around 15 to 16 million in 2024. And after the visa-free treatment to Chinese, we do believe the Chinese tourists will be more and more returning to Singapore. And from a RevPAR perspective, the revenue per available room, we have to say due to the high base effect and the easing of some of these revenge traveling, the RevPAR is already declined a bit from this previous peak. But some of our key holdings, some key hotel REITs holding, they can still report some improvements versus the pre-COVID levels. And the current pressure is not only Singapore specific, but also impact other regions. But more importantly, if you look at the bottom left chart, the Singapore hotel supply pipeline is very limited, partially thanks to this 3-year COVID period. So from a supply perspective, the limited supply can still support the hotel sector. And this page lists most of our major holdings rental reversions with their rental reversions outlook. Overall speaking, the rental reversions may be a little bit moderate, but can still deliver a good growth. And in the meantime, the operating cost, we have to say now is much better, the situation, because the wage growth is easing. There is less tight labor market, and also there is a lower average uniform Singapore electricity price. And once again, the interest rate is still one of the major concerns of everybody because it has a direct impact on the S-REIT's borrowing cost. But at the current stage, we also think it is a double-edged sword because once it turns, it can also act as the biggest driver for the future rebound of the S-REITs. And over the past 2 years, thanks to this continuing hike of the Fed, the S-REITs borrowing costs have already expanded by more than 1%. And on a forward-looking basis, for this year, the borrowing cost is likely to peak out by rising another, let's say, up to 50 bips, because all the cheaper costs will be roll over given roughly a 3-year the borrowing length. But the good news is here, here is that the Fed, there may be no immediate cut. There's also no expectation of the future hikes. So once the funding cost is going to peak, then all the negative will be priced in. And then once the interest rates start to go lower, it will be trigger even a larger rebound. And despite the high borrowing cost, the S-REITs gearing, the debt to the total asset, are still well contained thanks to the rental growth as well as the relatively stable Singapore cap rates. So from this perspective, most S-REITs, they still have the revaluation buffers before reaching the MAS regulatory 45% gearing limit. So from this perspective, they can still develop some projects, conduct some M&A by adding a bit leverage a bit. So we still have some buffers here. And also the widening yield spread, the dividend yield versus the cap rate, are really constructive to the interest rate coverage ratio and also the distribution per unit accretion, as well as the acquisition growth. And more specific to sector impact, such as industrial, logistics, business parks, and data centers are still quite accretive. And relatively speaking, the retail and hotel their spreads are relatively neutral, but office are still a bit dilutive for now. So overall speaking, looking forward for the rest of the year, a lot of headwinds are turning into the tailwinds. For example, inflation is cooling down, operating costs start to decline from previous peak. Borrowing cost hasn't peaked, still have some room to go, but it's going to peak. But most important part is that the monetary tightening is already behind us. I think that's the most important part. And from a valuation perspective, we have to say the so-called yield spread between the S-REIT yield versus the risk-free Singapore 10-year bond yield still looks tight. If you look at the line in the middle, the blue line in the middle, but it's becoming more fair. So it's not super expensive for now. And if we do a scatter plot, if you can see this small red dot here, which shows the March end valuation, it still looks quite in line with the historical the trended line as shown here in the dotted line. So from this perspective, the valuation is not super expensive. And more interestingly, if you look at the price to book valuations, the current less than 0.9 multiples, it's really a good attractive level and a support level, so, which means once the sentiment changes, it will trigger a great rebound for the whole S-REIT sector. And again, back to our products. Our CSOP Edge S-REIT Leaders Index ETF was launched 2.5 years ago. And despite the continuing Fed hike, which put a lot of pressure, we managed to maintain a relatively stable AUM. And now the SRT is our major trading counter in SGD, and the SRU is our US dollar trading counter. And our dividend payout is half year, every 6 months. And thanks to this high for longer environment, our most recent dividend yield, it's annualized 6.5%. And since we are trying to mimic or be in line with our benchmark yield, and given our benchmark yield currently it's 6.4%, we believe our upcoming dividend payout, which will be in July, this year, will be still similar to the 6.4% or 6.3% level. And the index, I still want to spend some time on this index because this index is actually issued by the SGX, the Edge S-REIT Leaders Index. Their index is very transparent and straightforward. It comprises of the 22 large and mid-cap S-REITs listed on Singapore Exchange. We use the large and mid-cap focus because in the history, the large and the mid-cap S-REITs, they outperform their smaller peers given their strong pipeline and also the more healthy balance sheet and also the relatively lower funding cost. And in addition to that, we not only care about the market cap, but also care about the liquidity, which means we have a requirement of the daily volume and trade velocity to make sure we not only have the largest S-REITs, but also the most liquid S-REITs. So through this semi-annual rebalancing with a 10% cap for each single S-REIT, we tend to create a diversified portfolio And in the meantime, we try to capture the sector rotation for the S-REITs, which means we don't start from the sector selection, but our sector allocation on the top right is just a result of the liquidity and cap screening. For example, now in addition to these office or retail, as well as the hotel data center REITs, we also have a small position in the healthcare REITs for now. And more interestingly, even we are investing 100% in the Singapore-listed S-REITs, their underlying property projects can be way beyond Singapore. It can be APAC, it can be global. But for every individual investor, whether you are Singaporean or whether you are from other countries, as long as you are a retail individual investor, you invest in S-REITs, S-REIT ETF, you will not subject to any withholding tax. So which means you can access the global projects, but you can still tax-free. And from a performance perspective, and since inception, we have outperformed our benchmark by more than 60 bips. So in other words, even we deduct the whole TER, the total expense ratio, the 60 bips, our net performance is still better than the benchmark. So investors should not worry too much about this management fee we charged. And again, the ETF, as an ETF vehicle, we also provide the diversification and also the liquidity. And here is the top 10 holdings of our benchmark as end of April. And investors may ask, why don't we just directly invest these portfolio? Of course, you could if you have a high conviction, but you should notify that if you directly invest in the S-REITs, your trading costs can be quite high because of the relatively large beta spread. But through a dedicated ETF manager, we can trade the underlying S-REITs in a very, very cheap cost and transit this saving back to the end investors, as reflected in much narrower bid-ask spread when you trade the S-REIT ETF on the Singapore exchange. And also the diversification can also help investors to lower your volatility and lower your drawdown risk, but you still enjoy a relatively decent dividend yield. So in summary, if the Fed stay high for longer, but at least they don't continue to hike, the investors can still enjoy the decent cash dividend payout, roughly 6.3 to 6.5% through holding the REITs ETF, such as our SRT. But if the Fed finally start to turn, then the capital gain potential for these holding the SRT or the S-REIT ETF will be huge at the current stage. And I hope everyone can earn more money this year. Thanks.